It's Tuesday, June the 24th, and this is a special episode of the weekly briefing from Capital Economics. I'm David Wilder. I'm joined by Group Chief Economist Neil Shearing and by David Oxley, our Chief Climate and Commodities Economist. Now, we're recording this hours after a ceasefire was reached between Israel and Iran. Since then, we've had strikes and counter-strikes, and Donald Trump has made his feelings known. This is a family podcast, so we won't repeat what he said, but it does sound like the ceasefire is holding. Yeah, I want to start with you. We did our usual weekly podcast last Friday, weighing all sorts of macro and market uncertainties around this fighting. Does the news that we've had over the past 24 hours or so lift those uncertainties?
It does to some extent, but I think it's fair to say that the truce that's been announced is going to be a fairly fragile one. I think it's cleared some parts up and made some things less uncertain, but I wouldn't overplay that. So if you think about how ceasefires between Israel and both Hezbollah and Hamas have played out over the past year or so, they've not held. So I think it would be a mistake to conclude that this is the final word. However, it's pretty clear that the US, there's strong political commitment to this, and a strong political push from the US to make this ceasefire stick. And we've seen that, of course, over the course of today. So one of the things I think we've learned is that the US in particular, having entered the conflict over the weekend, there's now been a strong push towards peace and drawing a line under this conflict. I think the same might be true of Iran too, if you think about the way in which those attacks on US bases in Qatar yesterday were signalled. I think the other point worth stressing is that it's notable that energy infrastructure in particular has not been targeted in this conflict. So that removes potentially one source of uncertainty as well.
Energy's been very much at the heart of this, hasn't it? This is the point that you were making on the podcast last week. David, let me ask you quickly, what next for oil prices? They've been on quite a roller coaster, haven't they?
Yes. Ever since the start of fighting between Israel and Iran, it's really been the concern that the ability to export oil from the Middle East, which of course is a major oil exporting region, would be affected. That's really been front and center in oil traders' minds. This could take a number of forms. People were worried about potentially whether Israel could target Iranian oil exporting facilities, and also whether Iranian could strike back and attack energy export facilities in some of the key exporting countries in the region as well. But the biggest risk that's really been playing on people's minds has been whether Iran would move to close shipping traffic through the Strait of Hormuz, which, given that is a vital artery for global energy industry, would have had a significant impact. What we've seen over the last 24 hours or so, since the sort of largely orchestrated retaliatory attack by Iran on the US airbase in Qatar, there's a big sigh of relief, really, that this was seen as de-escalatory, and some of the extreme risk of Iran potentially moving to shut the Strait of Hormuz. Traders have clearly downgraded the probability of that happening, which has pushed oil prices down significantly. So at the time of recording this, oil prices are trading Brent crude is back below $68 per barrel. That's down 5% on the day. It fell 7% in trading yesterday. So we're about 12% off where we were this time yesterday. So quite significant moves.
Yeah, I should say we are recording this at 3:30 London time. That's 10:30 New York, just for context. But talk a bit more about oil. Just a short while ago, you put a note out saying that focus now would switch back to oil's fundamentals, but they don't sound very good, do they? So give us a sense of where prices go.
No, exactly. Coming into this conflict, although oil has been trending down for quite a while now, all the focus leading up to this was on the actions of OPEC Plus and their pivot that we saw earlier this year, in which they were clearly gearing up to add more oil supplies into the market over the next 18 months or so. That wouldn't be bad if the oil market or demand for oil was surging, but it clearly isn't. So we're continuing to see a weak backdrop of global oil demand. This is partly what we're seeing this in the US, but cyclical factors at play, and sort of normal cyclical factors that people look at. But what's really becoming clear on the oil front is that some of the structural headwinds to oil demand, particularly in China, are coming to the fore. China's the rollout of electric vehicles and LNG powered trucks there is clearly starting to have an impact on oil demand growth. So yeah, as you say, the fundamentals, weak demand, but plentiful supply in the oil market really does add up to downward pressure, we think, on oil prices. For what it's worth, we released our outlook yesterday with our latest forecast. We stuck with our existing forecast for oil, which are quite considerably below the consensus. So we have Brent crude falling to $60 per barrel by the end of this year from $67 per barrel as a time of recording. And we have oil prices falling to $50 by the end of 2026, which really reflects our view that a substantial surplus is going to open up in the oil market over the next 18 months or so.
And just to be clear, you haven't adjusted your forecast while this situation has been going on.
No, we correctly diagnosed that what we've seen was a big spike in the risk premium in the oil market, which, as we've seen before, can come and go. And it came, and as we've seen over the last couple of days, that risk premium has dissipated incredibly quickly as the market has downgraded the probability of a risk of disruption to the Strait of Hormuz. So, yeah, we stuck to our guns, which were driven by the fundamentals. And I think that's increasingly what's going to come into view in oil market participants over the coming weeks, if this all continues to die down.
So that's key, isn't it, Neil? If this still holds, let's assume it does for all the uncertainties that you've spoken about. What does that mean then? Where does the market focus shift now? Are we now moving back to worrying about tariffs and tariff deadlines and what happens to those Liberation Day adjustments?
I think we probably are. I think there are probably three sets of concerns here, aren't there? There's the events in the Middle East, there's tariffs, as you mentioned, and then there's the US fiscal position as well, and that bill that's working its way through Congress, where the deficit ends up, what all that means for long-term fiscal sustainability in the US. And so my sense is that, yes, the focus over the next couple of weeks is going to start to shift back to those issues, fiscal and tariffs. And as we've talked about before, those in some senses are two sides of the same coin, because one of the reasons that we're seeing tariffs go up is to generate some revenue for the US government that it can then recycle into tax cuts. So I sense that's where the attention is going to shift back to. But of course, the point that I was making in my note on Monday this week, and that we have discussed on the podcast before, is that we're living in a world where uncertainty has increased, and that's different from risk. So uncertainty can't be quantified, risk can be quantified, and these issues are inherently uncertain. What's Trump going to do about tariffs? No one really knows. At what point will the bond market's patience with these large deficits and increasing debt burden start to crack? Again, uncertain. And will this fragile peace in the Middle East hold? Again, uncertain. So we're in a world of rising uncertainty rather than risk. That's inherently unknowable. And so I think, dare I say it, we're going to have to get used to a world subject to more extreme outcomes, and I'm afraid where economic forecasts are sometimes wrong.
Apart from capital economics, we're never wrong. Thank you, Neil. Thank you, David. David, I'll put a link to your latest note and to that commodities outlook on the show notes. Neil, I'll add a link to your Monday note. Despite this agreement to cease hostilities, this is a fragile situation, and we are continuing to track it to assess macro and market vulnerabilities. Our platform is still where you're going to find the latest analysis on this. But if you want a meeting with Neil or David or any member of the Economist team to talk through these issues, do get in touch and we will see about arranging a sit down. That's sales@capitaleconomics.com. But that's it from me. We will be back on Friday as usual with our weekly podcast. Until then, goodbye.